BridgePort is a fintech technology company that connects exchanges to custodians. What we do is we connect crypto execution venues to crypto custodians, and that could be an enterprise custodian, banks, wallet providers. The purpose of that is to allow trading firms to hold assets at a custodian, escrow, and pledge for trading. And using BridgePort, they will allocate notional balances on the exchange, which in return gives them a credit line. Today, trading firms are pre-funding assets on multiple exchanges in order to trade crypto. And that obviously subjects them to credit risk, opportunity cost, low ROI, as everyone is aware. And it's one of the reasons why the FTX implosion was really enabled.
Why did you partner with Crypto Finance?
Crypto Finance is a crypto custodian that is part of the Deutsche Börse group. And what we're doing is connecting BridgePort's middleware to Crypto Finance, which will allow trading firms to hold assets at Crypto Finance and pledge that for trading. By pledging it for trading, they no longer have to pre-fund on exchanges, so the funds are held securely at the custodian. And BridgePort, in this off-exchange settlement setup, is building out a network of custodians and execution venues. So the first announcement we made was with Crypto Finance, and the next coming weeks, we're rolling out more custodians and exchanges. The pipeline of exchanges we're working with, it's going to be the initial institutional ECNs and exchanges, because those are the ones that are most receptive for off-exchange settlement, because institutions today can't afford to pre-fund on multiple exchanges, right? And the technical challenges we had to solve is that each stakeholder, whether that's an exchange or a custodian, is set up differently. Our role is to be able to synchronize those messages between an exchange and a custodian, or multiple exchanges and custodians at the same time. So we've had to build a purpose-built tech stack that is aimed at making this connectivity very seamless. So when we work with a stakeholder, whether that's an exchange or a custodian, we actually write into their APIs and build out a customized adapter on our side to manage that integrations and connectivity. So it's a very low lift, friction-free effort for the stakeholder. It allows us to manage those messaging services between an exchange and a custodian as required by trading firms.
How does this exchange settlement model compare to traditional crypto trading infrastructure?
If we look at the landscape today for institutional crypto trading, the prerequisite for institutions is to be able to pre-fund on exchanges. They have to park assets on the exchange and trust that the exchange is going to hold it securely. And this is one of the reasons why the FTX implosion occurred, the Bybit hack happened early in the year, and we want to be able to go past all of these instances and get crypto to a mature state, which will invite the next wave of capital, right? So through Crypto Finance, they have a product called Anchor Note, which allows trading firms to pledge assets. So by pledging assets, those assets for the trading firm are locked and secured. So the trading firm cannot withdraw or unilaterally or double allocate them. So we ensure as BridgePort that those funds are available at Crypto Finance and locked, and then send a message to the exchange where the trading firm wants to be able to trade. And that's the core tenet of off-exchange settlement, is the funds are no longer held at the exchange. They are held at a third-party custodian in a secure manner, which allows for greater capital efficiency. As we've spoken to many tier one market makers who are pre-funding on up to 15 different exchanges, if they're not using those assets at any given point, that essentially becomes dead capital sitting there at the exchange. So by holding assets at a centralized custodian or at a couple of custodians that are able to allocate credit on the exchange as required, as opposed to just doing some guesswork and thinking they may be able to trade at a particular exchange, right? So capital efficiency increases significantly. And this is going to be a great unlock for the exchanges, because that's going to increase depth of the liquidity as well. It also unlocks volumes for the exchanges. For us to be able to grow at a 100x level, we need greater depth. We need safeguarding of assets, and we also need to be able to tell the next wave of participants that this is secure infrastructure that they're already familiar with, and this is how crypto is going to grow.
How did you decide on your geographic rollout strategy?
The geographic rollout strategy and the regulatory requirements are really constrained by what is imposed on a custodian or an exchange. BridgePort as middleware, we're a technology layer, does not partake in execution or custody, right? So we're passing messages or payloads of data from one endpoint, which would be a custodian, to the exchange. So in this case, crypto finance are regulated and set up to do business in Switzerland and parts of Europe. And those are the customers they're targeting and currently onboarding. So if you look at the types of customers that are coming into crypto, was initially the crypto native hedge funds and market makers, right? And in the last 18 months, we've seen ETFs that have allowed traditional asset managers and hedge funds to get into that space. And now we're seeing corporates use crypto as part of their treasury strategy. So all of these firms are going to be involved in crypto, and they need custodians to be able to safeguard their assets. And whether it's in Europe or in the US or in Asia, we're going to need reputable, regulated, and fundamentally operational custodians to be able to work with these types of customers, right? And those are corporates, hedge funds, asset managers, market makers, buy-side firms. So in this initial rollout, we're looking at those types of customers coming out of Switzerland and parts of Europe that would need to be able to trade crypto and want to be able to do it in a secure and risk-mitigated fashion.
How does BridgePort fit in with infrastructure providers?
We see ourselves as complementary to infrastructure providers, and that would be the likes of OEMS providers or even prime brokers. Our role is to be able to sit alongside those kinds of infrastructure that's being built out or already built out, right? So if we take OEMS, for instance, that is focused on execution, whereas Bridgeport, we sit on either side of that. We look after pre-order credit allocation that needs to happen before orders are even entered into the system at an exchange or with the OTC counterparty. And the second function is post-trade settlement facilitation. So once the trades are executed on OTC or an exchange, collecting, tabulating, and sending that as settlement instructions to the custodian in the exchange. So we are very much complementary. And what middleware has allowed to do in, say, FX and interest rate swaps and stuff and other related asset classes, it connects exchanges to clearinghouses in that space, right? And that allowed multiple exchanges or execution venues to be created for greater liquidity, trading, and ability to arb between those execution venues. So in the same way, we are providing a very specific function, which is pre-order credit allocation, post-trade settlement facilitation. So we're not competing with the other types of infrastructure. In fact, we allow those services to be enhanced. Specifically, prime brokerage, for instance, where today a lot of the prime brokers are pre-funding on multiple exchanges. Instead, they'll be able to hold assets, say with crypto finance's anchor node, and then allocate in real time as these opportunities arise for their underlying customers. So again, capital efficiency goes up, which means the cost of funding for prime brokerage should come down, which is then passed down to the customers as a cheaper spread or cheaper commission.
What are the most important lessons from Dodd-Frank that apply to crypto regulation?
Dodd-Frank's ambitions was to make the markets more transparent and avoid this sort of systemic risk that caused the GFC right in 2008. So when the SEFs came about, that required implemented a new type of execution venue which had pre-trade reporting and post-trade reporting as well, depending on the type of assets being executed. So Steve and I spent over a decade building out these SEFs, initially at ICAP, then at CME as well. CME eventually acquired the companies that we worked at, namely EBS and BrokerTech, which had built the SEFs for FX and interest rate swaps. So what we learned out of those years was regulations have an intended and unintended consequences, right? The intended consequences in Dodd-Frank was to make the markets more transparent. The unintended consequences was to break up liquidity. And we saw this specifically with FX NDFs, where those non-deliverable forwards that were traded by US persons or those related to US persons was a segregated pool, as opposed to another pool which was specifically for non-US persons from Asia and Europe. So that was an unintended consequences that broke up liquidity and obviously would have impacted spreads. The parallels we were drawing from our experiences from implementing Dodd-Frank is Clarity Act is meant to provide a framework for market structure. And we've seen how the industry has been screaming for regulations and guidance, right? Because otherwise we're just working in the dark and hoping, well, we don't breach some sort of unintended rule that was created in the 1930s. So it's amazing, and something to be commended that US is on the forefront with the Clarity Act. And one of the pieces in that act is to segregate assets that an exchange holds, a crypto exchange holds for it, between the assets it holds for itself and the assets it holds for the customers. And this is something that we've been pushing for, and that's one of the reasons why we even built this company, is because we knew the exchanges and the industry couldn't scale if the fundamental prerequisite is to be able to pre-fund on these exchanges. So Clarity Act, while there are intentional consequences such as what I mentioned, there could be unintentional ones as well that we're not entirely aware, because the bill is still about to be passed, and I think it will happen later this year or earlier the next year. But we've already seen the fruits of those intentions, with the CFTC creating their request for comment and the SEC also working in tandem with the CFTC. So I'm very hopeful that the Clarity Act will bring about the market structure that we deserve, but we also have to be cognizant of the unintended consequences, not just here in the US. It may have ramifications for other jurisdictions and how they roll out their regulations, or how it impacts existing regulations.
If the Clarity Act were in place, how would the FTX situation have changed?
In the proposal, we've seen the requirement for exchanges to segregate customer assets and the exchange's assets. If that was in place with FTX and we had verifiable evidence that the assets were segregated, then those nefarious actions that took place a few years back shouldn't be possible, where the exchange is either intentionally or inadvertently using customer funds to prop up the exchange. That sort of market structure framework is table stakes for any sort of regulations. And it's not just in the Clarity Act. I think we're seeing that across other jurisdictions as well, where the regulators and governing bodies want to hold the exchange accountable and want to protect customer interests, specifically retail customers' interests, by ensuring the funds that they pre-fund or they pledge or they use for trading are segregated in a way where it cannot be used for the exchange's own purposes.
How effective will the CFTC be implementing the Clarity Act with only one commissioner?
You want a full quorum. Obviously, I think normally there are five, and they're usually split by party lines, where three is along one side and two from the opposing party. It's not ideal, but I think we are approaching that timeline where a chairman has to be nominated at least before they're placed into the seat, and then hopefully we'll follow that with the commissioners. But yeah, we don't want a situation where later on down the track there's arguments about these market structure or anything else that was implemented by the CFTC because there weren't sufficient commissioners on board, right? But I think what the CFTC are doing is somehow separated from the Clarity Act itself, right? Because that has to go through the House and the Senate in its own right, without being influenced by what's happening at the CFTC. So I'm hoping the Clarity Act passes through the rigor, and then by the time it gets to the CFTC and other agencies to be rolled out, we have quorum and we have commissioners in place, and hopefully this is next year where we have sufficient time to be able to get that in place.
By focusing on crypto, are we neglecting TradFi market risks?
The C in CFTC stands for commodities, right? So we have to be aware that, especially those who don't, for the uninitiated from outside of TradFi, the CFTC actually regulates the commodities markets, whether that's wheat, pork bellies, oil, all of the stuff that have liquid markets that have been formed over the last 100 years in the futures and options spaces under the CFTC's purview. And I've never seen so much interest in the CFTC and all the salacious gossip that's going on in crypto Twitter. I wouldn't have thought that the CFTC and the imminent appointees would be in the middle of that. But yeah, it is very interesting to follow that on crypto Twitter if you have a spare few minutes. But yeah, I agree with you. There's a lot of focus on crypto. Crypto is a very small market compared to just about every other asset class, right? It's a small but growing and burgeoning market. And I hope that this fixation on crypto in the last couple of months is exactly that. And we'll be able to move past that focus and get commissioners on board who can appreciate the need for crypto and the need for crypto to be in the US, as opposed to regulations by enforcement or having a iron-fisted approach, right? So I'm hoping that as you say, we don't get bogged down by just crypto-specific news and at the risk of what happens in commodities. I don't think that'll be the case. It's a big enough market where commissioners and all the other regulatory agencies will have to focus on TradFi, and crypto is just going to be one part of their portfolio, right? Just like larger companies, whether it's banks today looking at crypto, or the CME creating a crypto division. Yes, it is important, but so is the rest of the business, and there'll be advocate focus on each one of those business lines and not just on crypto specifically.